So we're doing our Barita Brain Trust Bites, where we take a time to have some snacks and then answer some shorter questions for our viewers. Raul, one of the things I'm realizing, question that comes up, I just bought the most recent IPO.
Yeah.
And the stock price has fallen. It go down. It don't fly up like the other ones.
It's a crisis.
It's a crisis for some people, understandably. So the question is, what is it that we would have to say about that? Should people be expecting that when they're coming into an IPO?
Did you call your Barita advisor before? It's said in jest, but there's a lot of meaning behind it, because investing is a journey that I think you should do with an advisor, you should do with a professional to help to tailor what you do to your particular life situation.
Right.
You know, and you can manage your money and importantly manage your risk within that context, because stocks can be quite volatile. Right. And it's important for people and investors to appreciate that what we're trying to achieve in stock investing in particular is growth in wealth and capital over time. So you shouldn't go into any stock investment really, and certainly not IPOs, without a kind of 3 to 10 year horizon.
Wow.
Yeah.
Yes, I mean, you're really talking about just managing your expectations as far as that particular investment is concerned, right?
Yeah. And you know what you're trying to accomplish and how you allocate that risk and return, risk reward, potential reward paradigm is an important conversation to have with the advisor. And people have to understand, like I tell people, Mr. Market, the stock market is like a manic neighbor that you have. Yeah. So the stock market is just this Farmer Joe that you live beside, right? And for us as professionals, our job is, so you have a cow, and every day you wake up and you ask Farmer Joe to quote you a price on the cow, right? Most of the time he's within a reasonable range, right? So, you know, I mean, how much a cow cost these days, Sean?
I have no idea.
So let's say a reasonable price of a cow is $60,000, right?
Okay.
So most days when you ask him, he might say, boy, me give you $50,000 for the cow, right? I'm gonna give you $60,000, I'm gonna give you $70,000 for the cow, right? And that's in and around the price that a professional, knowing how much corned beef you can get out of this cow, will understand, right? But he's manic. So some days him wake up and him vex, you know, and you say, how much for my cow? You're lucky if me give you $10 for that cow, right? You don't pay him no mind in that time, right? But when him come home and him eat a big food and, you know, the farmer go on good and him feel good and him come out and you say, Joe, how much is the cow? I say, all right, you know, I have 600,000 me give for that cow. Then you sell him that cow.
when he's excited, yes.
Yeah, and I mean the stock market is kind of like that, where, you know, if you turn it around and he's selling the cow and he's manic and he's trying to sell you the cow for $10, you buy the cow, right? Because you can cut him up and you can make X amount of tin of corned beef and sell it, right?
So I mean, what you're saying is basically you have to know the underlying value of that asset.
Yes.
Right? And so that's where, I mean, one of the things that we always do as far as we're looking at stocks, we do some simple valuation things. So we talk about price to earning ratios, price to book value. But all of that is just our way to say, listen, the cow, the underlying value of the cow is this. Based on what's going on in the actual market, when you go and sell it and you sell it to the butcher, and he's going to portion it to make these sort of goods. I think your analogy is very relevant for sure.
Yeah, so that's the important role that your advisor plays, because you're a brain surgeon. you do brain surgery.
Yeah.
Right? And that's where your time should be spent. Your advisor has a whole team at Barita or wherever that is looking at these companies or looking at these investments and saying, okay, the fundamental value is here, the growth prospects are X, this is where we think you should land. This is a range we think you should land around the next 3 to 10 years, right? And we have a thoughtful process that leaves us with numbers and the uncertainty around those numbers.
Right.
So when we're having that conversation with you, if you have a son about to go to university overseas, we factor that into the conversation with you as a wealth advisor.
Right.
You understand what I'm saying? If you're in your 3rd year of a great career post and you really just want to stack some wealth for your retirement out in the future, 20, 30 years down the road, that's a different conversation.
Right.
So everybody's situation is different.
That's right.
So we will apportion the risk that you take differently, which is why I'm saying, regardless of who you are, what you're investing in, you should have that conversation with your advisor.
Because again, it doesn't matter if this is a good stock or not, because the question is it a good stock for you?
For you.
That's right.